When we buy a home, there's four things that we're going to look at that goes into our mortgage payment: principal, interest, taxes, and insurance. That insurance is homeowners insurance, and many of us don't exactly know what it does. So today I've got Steve Wills from Goosehead Insurance who's going to tell us a little bit about what homeowners insurance is and what we need to look for. Stay tuned.
It's time for the Real Estate Minute with me, Lynn Wayman, your Kilted real estate agent, bringing you what you really need to know in just a few minutes of your day.
And as promised, here it is, Steve Wills from Goosehead Insurance. Steve, welcome to the show.
Thanks, Lynn. I appreciate you having me on.
All right. So you do insurance. You work for Goosehead. You've been doing this for a while. How long have you been doing this?
I have been in the insurance business since about 2005.
Okay, so you've
So
really
it's been about 14 years. Yeah,
14 years. That's quite a bit of experience. So tell
absolutely.
me, 14 years of experience, what it is that, what do I need to know as a person buying a home? What do I need to know about homeowners insurance?
Sure. So typically with most people, the thing that they learn about first is how the homeowner's insurance gets paid for when they're purchasing a home. So if you're buying a home and you have a loan, then your homeowner's insurance is most likely going to be wrapped into the mortgage. The first year is going to be paid as part of the closing costs, which the lender usually estimates for. And then the mortgage company is going to hold a small piece of each mortgage payment in an escrow account, and that'll build up through the year, and then that'll be used to pay for the renewals each year that the insurance comes out. So when you start in your a lot of my clients are in the home buying process when I'm helping them out with insurance. So when you start in your process and the lender gives you that estimate for how much your mortgage payment is going to be before you get out there and start looking at homes, that estimate is including what they think your homeowner's insurance is going to cost. But it's not an exact number yet until you find that house and get the quotes and decide what coverage levels you're going to go with. So keep in mind that those loan amounts are approximate, not so much direct prices on that. So if you are really close in an approval, like let's say you are looking for a $200,000 house and you're approved to $200,000, sometimes it's good to check and see how much the insurance is going to be before you decide to go ahead and move forward with that purchase, so that you can make sure that the amounts are still going to work with your mortgage payment and your qualifications and things like that. Which kind of brings me to the next thing, which is the things to kind of watch out for. What could make your insurance be more than what you were expecting as you're looking for a house. So generally speaking, the lenders are estimating based on what most people are paying for an average house in your price range when you're buying a house for the insurance. But for instance, if you buy a house that's way out in the country, far away from the fire department, it's going to have a higher cost for insurance. If you buy a house with an older roof or certain dog breeds, it might give you a higher cost of insurance. Prior claims even from a previous homeowner could possibly cause the rate to be more expensive than what you were expecting. So if you're in a really tight number situation, it's a good idea to kind of check those things, because that's where I see most people get hung up with homeowners insurance, especially in the home buying process.
I didn't really realize all those things could change how much you charge for insurance. Dog breed specifically, I didn't realize that would actually change an insurance policy.
It does, and that's a sticking point for some people, because some people get offended when you tell them that their particular breed of dog is going to cost more. And I'm one of those people, because I have a dog that's on a lot of those lists. But insurance companies are mathematical. It's statistics. For them, the ones that choose to put those things in place, they take a look at the amount of liability claims they have for dog bites, and then they look to see what the most notorious breed offenders are on that list, and that's usually how that happens. Generally speaking, a company either will or will not cover you if you have one of those breeds. So it's not so much that it directly makes it more, it just eliminates a lot of your options, which could have been the least expensive options for you.
All right. Well, as far as, talking about that sort of thing, what about, and you were going with the premiums, but what about on the other side, if I'm making a claim? What kind of
Gotcha. So this is where the deductibles come in big, and this is big when you're shopping for insurance. You're usually going to have two deductibles on your standard homeowners policy. You're going to have what's called your all other perils deductible, and then your other deductible is either going to be called a wind and hail deductible, or it might be called a hurricane deductible or a tropical cyclone. Essentially, that's very common in the coastal area that we're in, because wind and hail and hurricane claims make up a large portion of what we see. So generally what that means is standard, you'll see $1,000 deductible for all of the perils, which would be like a fire, a theft, a vandalism. And then you'll see a different deductible, which sometimes will be a dollar amount, but sometimes will be a percentage amount that will either be for wind and hail or hurricane. So a lot of times you'll see, let's say, 2% deductible, for instance, on a wind and hail. What that means is that if, let's say, your home is insured for $100,000 for easy math, then if you had a wind and hail related claim, your deductible is 2% of $100,000, so $2,000. So you can see where if you get into like a $400,000, $500,000 house, you could have a $8,000 to $10,000 deductible for wind and hail. Now, if it says it's a hurricane deductible, then that means that the wind and hail claims would still stay under that lower $1,000 deductible, but those higher, like a hurricane, would be under that higher. So it's always better if you're going to have the split deductible for it to be more specific, like a hurricane, tropical storm, and not just a straight wind and hail, or at least you know what you're getting into before you buy the policy.
Now, deductibles, don't those also go into how much you spend?
You mean are you talking about the percentage basis?
Right.
So, well, the percentage, a lot of people think that. So a lot of people think, oh, if I have a $10,000 claim, it's 2% of the $10,000. But when you have those percentage deductibles, it's a percentage of how much they're insuring the value of your house for. Oh. So regardless of how much the claim is, if you have a $400,000 house and a 2% wind and hail deductible, you're going to have an $8,000 deductible for any claims wind or hail related.
Okay, well then that makes a lot more sense then.
Mm-hmm. Right.
So then really, what is the question that people should ask that they don't ask when they're looking around and they're going with you, they're sitting down with you? What don't they ask that they should?
The liability limits is the one thing that I see lacking a lot of times. Liability limits are what's going to cover you in the unfortunate event that something happens on the property and somebody wants to sue you. Like, for instance, those dog bite situations that we were talking about, or the neighborhood kid falls out of the tree and breaks his leg, So those liability coverages are going to not only cover the damages, to help fix the kid, but if there's a liability lawsuit that comes along with that, where they're suing you, it's going to cover your legal defense as well as those liability payouts. Generally speaking, most mortgages only require you to carry $100,000 in liability. And usually you'll see most people go with $300,000, but the cost difference in premium to go from 300 up to usually $500,000 and sometimes even $1 million, depending if the carrier allows it, is usually less than 10, 15, 20 bucks a year in the premium. So if you think about it, to get an extra $400,000 to $300,000 worth of liability coverage for just that little bit, it's almost a no-brainer. And I see a lot of times people think they're getting a better price on the premium, and really when you show them how much they're saving for how much they're giving up in coverage, almost every time it's better to go with the highest liability limits that you can afford, especially on the home.
Yeah, I mean, that just seems like it's a buck and change a month and that's it.
Oh yeah, and most people never use that claim, but when you do, those claims are never small. They're always a problem.
I can imagine.
So, absolutely.
All right. So what else do I need to know about if I'm a homeowner?
So when you're looking for insurance, a lot of people ask, what do I need to do to get the best prices on insurance? Insurance companies are essentially complicated calculators that they've come up with to factor in the risk and reward to figure out how much they can charge to still be competitive in the marketplace and make a little bit of profit after they pay out their claims and expenses. But different insurance companies rate differently on different things. So some might rate more heavily on the age or the marital status of the homeowner. Some of them might be distance to the ocean. Some of them might be age of roof, or they give different things. So really the only way to find the best rate for insurance is to check as many places as possible. It doesn't necessarily mean one's company is bad or not. It just means with their algorithm, you're not ideally fitting into that thing. So that's why working with independent insurance agents can be helpful, because they have the ability to work with 20, 30 different carriers simultaneously, so that they don't have a vested interest in promoting one particular carrier, more so that they can, kind of in the same way as you as a real estate agent, when you're showing houses to buyers, you're showing multiple houses, you're not representing one house, you're representing the buyer and finding them the best option for that. Independent insurance agents, kind of a similar concept.
That really does make sense.
Yeah.
All right, Steve. Well, I'd probably love to go into this a lot deeper, but we are running out of time, and I really appreciate you coming on the show.
Yeah, absolutely. Anytime.
All right. And I hope some of my folks can use you or give you a call if they have more questions.
Hey, I'd love to help them out.
All right. Thanks a lot. And his information will be at the bottom down here. And y'all take it easy. And Steve, take care.
Thanks, Lynn.
All right. Bye-bye.
And that's your Real Estate Minute. For more useful real estate info, visit my website at www.kiltedagent.com. Connect with me, Lynn Wayman, the Kilted Agent, on Facebook, Instagram, Twitter, LinkedIn, all with the handle Kilted Agent. Follow me on YouTube, or catch my podcasts on TuneIn, Stitcher, Google Play Podcasts, Spotify, or wherever you download your favorite podcast. Until next time, take care and be well.